And we are back, second hour, Rush to Reason, Denver's Afternoon Rush, KLZ 560. Welcoming back David Stryzewski. David, welcome. How are you, CEO of Sound Planning Group, and how's your Monday starting off?
Hey, I'm doing fantastic, John. Happy Martin Luther King Day to you and the viewers here, and excited to be with you.
Appreciate that. So markets were closed today, I'm guessing, because of the holiday. What's the week looking like ahead?
Well, we're in the midst of earnings season right now, and this is really important because we're at this sort of interim place right now in our economy where we've all been expecting to see a recession. 2023, everyone was expecting it, and then it didn't happen. And now people are, saying, hey, is it actually going to happen? So it's a big deal for us to look at the earnings and the guidance that we're going to get on how the year is ultimately going to progress. And if I can be a little bit candid here, I believe the emperor doesn't have much for clothes on right now. And I think that the numbers and the data are beginning to show up. And I
can't argue that.
Paying attention.
No, I can't argue that. In fact, Dave, what I was going to say as you were mentioning that, I'm thinking to myself, people out there listening, especially those that are struggling, are probably thinking, yeah, you guys can say there's no recession, but when you look at inflation and you look at my paycheck and what I'm bringing home and the fact that I really have had to make some significant life changes to make sure I can still put food on the table and my kids have what they need and so on. And, me and my husband or my wife and I are going without things because of all of this. You guys might say there's no recession, but man alive, they sure feel like there has been one.
No question. And really it comes down to this idea of what we call cumulative inflation. In other words, how much inflation is actually in the system. It may say that, we went from 3.1 to 3.4, which is moving in the wrong direction. We can get to that in a minute. But the point is that the average American today has seen increases of, probably at least 23%.
At least.
Or a quarter of their paycheck is gone now.
Yes.
And for, paycheck to paycheck families, this is not just a significant deal. This is like the most important thing. And so you can, they can politicize whatever they want, call it, hey, we've got such a great economy, all these things are wonderful. Guess what? Unless you've got a whole bunch of money, you're feeling the impact of this.
Right.
And the average family in America today is waking up to this reality. And, we might be waking up to it at the beginning of a world war, which would also be very inflationary. So I don't see a lot of relief in the future, especially as gas prices are starting to go up now with this Red Sea stuff and having to go all the way around Africa. This is not great for the American consumer.
I was just going to say, what do you see for, and none of us have a crystal ball, the 2024 outlook. It's also an election year. I am one that believes, and you and I have chatted about this, I think the Fed has to do some things to make things more comfortable for those folks we just mentioned, i.e. they've got to get their interest rates back under control. You've got to give some relief for these people that are paying 30% on their credit cards. You're not going to have the housing market even doing what it needs to do unless you get some mortgage rates back down where people that are holding on to a 2.5% to 3% loan can feel comfortable moving somewhere else and loosening up some inventory and in creating some economy of that, if you would, David. I mean, there's lots of things that the Fed stifled, and I know they wanted to. And I, for one, am also saying, and I've said this now for really several years, the Fed doesn't have the same tools in the toolbox it once had, and I don't think they've woken up to the fact of that yet.
John, you just nailed something right there. And we have such short-term memories. If we go back to September 1981, when we were coming out of the last inflation cycle, and they actually pivoted too early, and Paul Volcker had to step in and jack the 10-year Treasury up and rates up to, extremes in the teens. I mean, we're at really low numbers in comparison.
Right. Good point.
This gave, the world a complete reset as far as how interest rates work and everything else, because we were able to reduce interest rates in our economy every time that we had any economic challenge. So even out of 2008, what happened with the housing market? Well, we had 7-8% loans, and they dropped them down to 4-5% loans, and then those got down to 3% loans as things continued to be worse. And then now we're on the flip side of that. And so where they were reducing rates and giving us the ability to go deeper into debt with the same 1/3 of our income buying mortgages, because that's all we can afford is 1/3 of our income.
That's right.
So that 1/3 of our income now on the flip side here with a rising interest rate environment can't afford the same amount of home. And so the whole market right now is going to have to get reset and could be just a real bloodbath for the average family, especially those that do not own a home today and are renting at very high and substantial rates as they're competing with, somewhere around 7 to 10 million new illegal immigrants that have crossed the border here in the last 3 years.
That's right.
Where are people going to go?
Well, and as I go back to the tools in the toolbox, and I would think that the feds, these guys are smart. They're not dumb by any stretch of the imagination, David, but sometimes I look at them and think, guys, you just live on a different street than I live on. You live on Wall Street, I live on Main Street, and the reality is you've lost the amount of tools you used to have to adjust things economically speaking. And David, I will say, I still don't think these guys fully understand that they have impact, but they don't have near as much impact on things as they used to. And we proved that this last year, by the way.
Yeah, and I mean, even with the Fed raising rates at the record pace that they did, and this is faster than ever before, so
that's right.
Important note. There's going to be impacts for that, but their tools are very blunt. It's like the lag effect is supposed to take somewhere around 15 to maybe 19 months to kick in. Rates go up. It takes that long for things to begin to reset. Well, of course, when you throw in $2 trillion additional dollars into our system, all this printing, PPP, ERC stuff, it causes things to just even go and extend out further. And so they're doing a number of things right now, and everyone's forecasting this, splashless landing that's supposed to occur in our economy. I vote that's what the answer is. But David Rubenstein said this. He said, a soft landing is actually not a real outcome from most Fed policy. What it is the transition from a growth economy into a recession. It's a softer landing. It's a transition time frame from everything's good, now it's slowing, and then ultimately, if you got an airplane in the sky, thrust and lift isn't enough, and it starts going too slow, things tend to fall. And so that is my personal thesis on where we're headed here in 2024, 25, and probably for the next decade. It's going to be a very rough ride, and we're going to have to deal with that and challenges. And the Fed's tools, just like you said, are not as effective as they once were, and I don't believe they have the ability to get inflation down to 2%.
I agree.
At least within the next few years.
I agree with you on that. So in light of all of that, you and I are on the same page. In light of all of that, what should people be looking at, whether they're A, just trying to survive, or B, they're looking at ways to thrive and make some money in that particular predicament?
Yeah, what a great question. So I think it's important to recognize, what is changing. And so unless we've got the right gauge cluster in front of us and we're driving down the road, if I didn't know how fast I was going, what was in the tank, whatever, it'd be very difficult for me to navigate something well.
True.
And so as we talk about people's financial futures and the journey that they're on, everyone's on a different path and everyone's in a different place. The point is that they need to have a real assessment and an understanding of where are they at right now. And I was thinking about this over the weekend, actually, as I was taking this. I was driving someplace that I hadn't been before, and I got to this Y in the road. And what was interesting is if you think that it's business as usual, you're on the same road, oh gosh, I got this Y in the road, which way do I go? You'll just probably kind of do the same thing as you've always done. And you know what? That might be the right answer in some seasons, except for what if we get to the place in time where it's really important that we pivot and do something different? I think you need to understand your why and why you would do something. So to answer your question, John, about where do we go, what do we do, investing in the stock market, I'd like to say this is the goal is to ride bull markets and to tame the effect of bear markets. But most people are all in all the time, and they do the buy and hold, park and pray, hope everything will be okay solution because they don't have a better answer, and mostly Wall Street portfolios are doing this. So a more active portfolio and selection process of where you're investing and why, very critical right now. There's certainly areas where we're seeing expansion in places like AI. But you know what? What led in AI last year is probably not going to lead next year or the year following.
True.
We're in this new renaissance moment. And so new ideas, new things are coming together, and that's going to be a big deal. I believe that we're at the beginning of a commodity super cycle right now. That's really important for people to understand. We can't just get copper and lithium and gold and silver whenever we want it. We actually have to go and produce it. And so it's critical that we're understanding that as the future turns and things go forward and supply chains are are a little messy, and potentially adversarial situations here with China, and they control a lot of those resources, by the way, and mine them. We may find ourselves not having as much as we once did, which then, of course, supply and demand causes the prices to go up.
Yep.
I also think it's critical for people to understand this. The safe part of their portfolios are bonds or fixed assets. I've got a new book coming out that's actually called Riding Bulls, Taming Bears, Investing in the 21st Century.
Oh,
and
great.
hoping it'll be out here in the next 30 to 45 days. But in this book, I go through these ideas, and I lay out the 5 ways that bonds lose money. And I believe that all 5 of these ways are literally blaring with warning signs right now. And so those that are looking at retirement, that are looking for safety, and they go for traditional answers, well, Wall Street's answer is load up on bonds. And ultimately, I believe that the losses that we're going to see within bond portfolios and in companies that are quote-unquote safe places to be are going to be very significant. So we need alternatives, and we need to be paying attention to why these alternatives, why now.
Got it. David Stryzewski, Stryzewski is how you spell it, CEO of Sound Planning Group. David, how do they get a hold of you, a website, and especially when the book starts to come out?
Yeah, so website is myspg.com. I've got a website I'm putting up here for your folks, though, fedbubble.com. The Federal Reserve has literally caused this bubble. They are to blame. I'm very critical of Jerome Powell. And fedbubble.com is a place for people to get more information and, look into some of these things. This is the time, if you're ever going to do it, to look into different ideas.
Agreed.
And get second opinions.
Appreciate you, David, as always. You're always welcome. We'll keep having you on. I appreciate you and I look at things very, very much alike, and I appreciate you joining us, sir, as always. Have a great evening, by the way.
You too, John.
You betcha. We'll do it, David.
Pleasure.
Appreciate it very much. I enjoyed talking to him, by the way. Great guy.